Did you fall sick during COVID? Maybe you were also hospitalized. Did you give up living? Of course not. That's why you are here watching the video. Now, why you didn't give up living? Probably you trusted God if you are a believer in God. Maybe you trust the doctors or the healthcare system in India or wherever you live. You did not give up just because it was COVID. And that was the worst ever that we all have seen in this generation. Then why do you give up when we see the markets going down? I know you are discouraged about the markets. Markets going down, crashing. 2025, the market didn't go anywhere. 2026 has started with once again, the tariff issues. And we don't know what are the other issues. But today in this video, and I'll take you through the last 25 years in India, we will look at a few things. We look at the GDP, we look at the markets, large, small, mid-cap space. We look at the corporate earnings and we will see how important it is. Then we will look at mutual funds. What returns mutual funds have given and why have they given more? Then we will integrate all these things and we'll see as a full picture how it looks for our country. The last 25 years, what has happened? Was everything rosy, cozy? No. There were many, many ups and downs. In fact, much worse probably than even COVID, what happened to the market. And finally, we will look at what is the future outlook. Probably this will help us look at markets, look at investing with a long-term and a very rational perspective, rational way of looking at it, not emotional. So are you with me? Let's get into the video. But before that, hello, I am Franky Fernandes. I'm the founder of Harmony and Money. It's a community focused at money and marriage. Money in isolation will not take you anywhere. Probably will make a lot of wealth, but there are many other important areas of your life that will get affected. But in this community, my focus is how to build your relationship, because ultimately this relationship is what will help you grow more wealth. Yes, grow more wealth and also be healthy and wealthy, both physically and mentally. And to that end, I encourage couples to join this community so that they can learn not just finance, but also how to do it together as a team. I'm a certified financial planner, a marriage coach, and also an executive coach. I help senior leaders in navigating through their careers and all the challenges that come with that. So without further ado, let's get into today's video. So let's first take a look at GDP, which is the gross domestic product of India, 2001 and 2025. What has happened in between this space? Very interesting. So what is GDP, gross domestic product? Let's quickly read this. I know you know it, but for the benefit of those who can learn something new, GDP includes consumer spending. That means all that you and I spend on all the goods and services. Government spending, the net exports, which means exports minus the imports, and all the investments that are made. It functions as a comprehensive scorecard of a country's economic health. GDP may be adjusted for inflation and population to provide deeper insights. Real GDP accounts for inflation. Nominal GDP does not. So obviously the real GDP will always be slightly less than the nominal GDP. Okay. India's economic and market landscape has undergone a remarkable transformation. So the last 25 years, we've from 2001, that is when we were $485 billion economy. Today we are 4 trillion. 1 trillion is 1,000 billion. Okay. So 4 trillion. And in this period, GDP has grown on an average 6.87% annually, which is very phenomenal. And the markets have delivered 14% plus compounded returns. And we will come to, in fact, it is more, and I'll show you. So this is where we grew, right? But now what does this mean really? From 485 to 4 trillion, what does it mean? Is it good, bad? How do we know? Unless we compare. And that's what we will do now. Let's do a quick comparison. So India, 2001 to 2025, this is what we have become, right? From 485 to 4.2 trillion. We have grown by, absolute growth is 3,000, that is 3 trillion growth, 8.7 times we have grown. Now, if you look at USA, Japan, Germany, UK, France, 2.9, 1, 2.4, 2.3, 2.3. The only country that is above us is China. They've grown from 1.3 trillion to 19 trillion. That is 18 trillion, 14.4x times. Of course, what is more important is how they are now and what is the future looking like. So we are in the best position. Let me share one more thing. So nominal GDP CAGR, that means compounded growth, 14.6. The real GDP is 9.8. We are second. Our nominal GDP CAGR has been 11.2. 11.2 nominal, and real GDP, that is taking out inflation, if you adjust for inflation, it is 6.8, which is great. If you look at all the rest of the economies, they're just one digit. So what does this tell? We have done great. Of course, what holds for the future, we will look at it in the last section, but this is what is the GDP. So now what we go is we move to the next section, which is the markets. GDP. How has GDP grown so much? We'll come to that. But what is a very important component of any economy is the markets. Because markets reflect what is happening in the economy. So we look at stock markets. So what has been the journey of Sensex and Nifty 50? Sensex grew from 3,600 in 2001, and I've been there. In fact, I've been in the industry since 1993. I've seen even lower than this. I've seen going up also and going down also. So in 2001, it was 3,600 to now around 86,000, which is in 2025. But of course, right now it is probably 84,000. So it has delivered the Sensex has delivered 14.5% returns, and Nifty has delivered 14.2% from 1999 to 2023. Right? If you include dividends, it exceeds 16%. Let's take a look at some of the years in terms of returns. So in 2001, the returns were minus 16 because of the dot-com bust. 2003, 71 points. So here we've got positives here, positives, more positives and less negatives. Yes, there are negatives here, 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 and here. And we all know COVID brought down the market, 25% returns in 2020. And Eurozone crisis, domestic policy paralysis, that is where we lost around 25%. And this was a global crisis, the worst in terms of the economy, 52% negative. We've seen all that. So currently, probably in the last year, we have seen 10, 15, 20% in large, mid, and small cap, which is really, really nothing compared to all this, what has happened. And what has happened to the liquidity in terms of the money that is being exchanged. 1 crore per stock was the average in 2001, average daily volume. And today it is more than 10 crore per stock, average daily volume. See the jump 10 times in 25 years. Now we look at the market capitalization segments, large, mid, and small caps. So let's take a look at the large cap landscape, 100 stocks. 2001, the stocks were Reliance. You had Reliance, some of the top 2000 in the Sensex or the Nifty. Then you had ONGC, ITC, Infosys, Wipro, Tata Steel, Hindustan, Unilever. Today, the 2025 top companies, only Reliance is the only one which is still the top. Which are the other top companies in terms of market capitalization? HDFC, Bharti Airtel, TCS, ICICI Bank, and SBI. So this is the change. This is the change that has happened in the last 25 years. Let's take a look at the mid-cap evolution from basically the 101 to 250th stock. Performance, mid-cap has delivered 16 to 18% CAGR, outperforming large caps, of course, but there's a higher volatility. Small caps, 251st onwards. Small caps have delivered 18 to 20% CAGR. Of course, there is high volatility. So this is the returns in the last 25 years. Let's take a look at the segment distribution. What was the size in terms of the size of the pie of each of these, large cap, mid cap? So large cap used to be 85%. Today it is gone down. It is 70%. Mid cap used to be 12% of the market. Today it is 20%. Clearly, mid caps have gone up in terms of value. And small caps used to be 3%. They are now 10%. So earlier it was 85, 12, and 3. Today it is 70, which has come down. Large cap has come down, and mid caps have gone up, and small caps have gone up. So this is a huge change which has happened. Mid caps and small caps have become more prominent, have matured. And what are the success stories of mid-cap success stories? HDFC Bank was a mid-cap, Maruti Suzuki was a mid-cap, Sun Pharma was a mid-cap. And all these three companies have, from mid-cap, they have now become large caps. Mid-cap evolution. Mid-caps were risky bets with low institutional ownership in 2001 and 2025. Mid-caps have 40% plus institutional holding. Analysts are covering index inclusion, right? It is now that they are an index. So this is the evolution that has happened in the mid-cap space. And in terms of the all large cap, mid cap, and small cap, all put together, the growth from 150 billion, it is now 4.8 trillion. There is a 32x expansion. I just wanted to just imagine the growth that has happened. Just imagine the growth in the markets. How has the markets grown? And why has the markets grown so much? We'll come to that. And wealth creation engine has been the mid caps. The mid caps have been clearly they are the wealth engine. They have produced 100 baggers. For example, Page Industries from 2007 to 2020, Eicher Motors from 2009 to 2018. They are multi baggers. They've grown multifold. Average mid cap company has decreased from 35 years to 25 years. That means they grow their life cycle from a smaller company to a larger company. It grows within 25 years, unlike earlier when it was 35 years. Hence, by the end of this second section, first we saw GDP and now the markets. Just think about it, visualize how we have grown. We have grown from 485 billion to 4 trillion. It's a huge, huge jump. And the markets, during that same time, the stock markets have given 14% plus 18%, 20% returns. If you were to look at large caps, mid caps, and small caps, all have grown. That means if you had invested your wealth, if you had invested in the markets only, the benchmark, Sensex, Nifty, or the other mid cap 150 or small cap 250, if you look at all those companies, your 1 lakh would have become anywhere between 25 to 60 lakhs. 1 lakh could have become around 26 lakhs, 26 to 30 lakhs in a large cap index, and 60 plus lakhs in a mid cap and a small cap. That is the power. That is what the market has given. Now we'll take a look at a very important component. In fact, this is what I would term as the thing that it moves the needle. And what is that? Where the GDP and the markets also depend. If this thing does not go up, neither the markets nor the GDP will go up. Let's take a look at it. Any guesses? And that is the corporate earnings. Very important component of this whole story. So corporate earnings basically are the earnings, the profits that the companies make. And we'll take a look at the large, mid, small cap and how it impacts the market. What is the correlation? Let's take a look. So the last decade, Indian companies across market capitalizations have delivered robust earnings growth, with mid-cap companies leading at 18 to 20%, 22% CAGR, followed by small caps from 15 to 17% CAGR, and large caps at 11 to 12% CAGR. This is not the market. This is not the market returns. This is the profits of each company. And they are separate. Okay. There is a connection. One moves the other, but this is separate. Okay. And so basically this is the profits. The profits that company make, base simple, if cost selling price minus cost price is the profit. So basically that is what is the profits. Let's take a look at the large cap earnings growth, which is Nifty 50 as a whole. If you look at all the companies in Nifty 50, and what is their average? So Nifty 50's consolidated earnings per share, EPS grew from 407 rupees in FY15 to 1070 in FY24, representing a CAGR of 11.3%. And here, if you look at it, from 407 earnings per share on an average, it has gone up to 1070. So this is what is the overall. Let's take a look at individually how they have compared. So mid cap earnings growth, Nifty mid cap. So that was the large cap. Now this is the mid cap. Mid cap companies have delivered CAGR of 18 to 22% over the last decade, significantly outperforming large caps. For example, a 10-year CAGR of 17.6%. Price returns correlate with earnings. So here is the actual earnings, and here is the market. The 10-year CAGR price returns correlate with the earnings. That means this is the return. This is the returns on the price. 17.6. 5-year CAGR is 21%. And small caps earnings Small cap companies achieved a CAGR of 15 to 17%. That means the profits of these companies over the last decade. And what is the market, the performance metrics? 10-year CAGR is 16.8. That is the small cap index. And here the 15-year CAGR is 17%, the small cap, BSE small cap. So this is what is the metrics of the, so this is the company's profits, and this is what is the profit of the markets comparatively. And a recent news says 80% small cap stocks are down. This is the news on Jan 26th. 80% small cap stocks down over 20%. Now let's take this is the EPS. Let's compare them. So this is EPS, that is the actual profits, and this is the price. And what is the CAGR? So large cap 10-year, in 10 years, 11.3% is the profits of companies. The CAGR, what are the returns year on year? Market has given 13.75, very close. Mid caps has given 18.2, and this is very fair, almost the same. Small caps have given 15 to 17, but the is 15%. So there is a gap here, there is no gap here, and probably there's a little gap here. So it's very important to compare them, that how each of them is moving. So it is very simple. Corporate earnings is what determines the markets. The markets will not go up and down randomly. They actually follow the corporate earnings. Plus, of course, all the news, the negative and the positive news, that spikes the market, goes up and down. For example, right now, our corporate earnings are not so bad, but because of tariffs, the future looks a little bleak for the markets, especially the FIIs. So they are pulling out the money. But once they are confident that things are settled, they'll come back. So the markets will go up and down. And so it is very important to see what is the correlation really. Is there any correlation? Yes, there is. If you look at the large cap, the corporate earnings versus market price for the last 25 years, what is the correlation? Basically, correlation means what is the connection? What is the change in the variable? If this is a variable, this is a variable. If this is the corporate earnings, and this is the market prices, is there any correlation? When this corporate earnings moves up and down, does anything happen to this? And that is what is this slide about. If this is going up, maybe it may not go up on the same day or the same month, but eventually it will go up. If it comes down, immediately it may not come down. Right? For example, during COVID, the markets fell. Corporate earnings didn't fall. But the corporate earnings later on fell, but then they came back. Market came back immediately. So you see, markets and corporate earnings, they don't move at the same time, but definitely there is a link. And here it is what it's showing. In 2001 to 7, the large caps, the market correlation was 0.89, almost 90%. Almost 90%, it went up or down according to the corporate earnings. 2007 to 9, yes, this was a period when the credit crisis happened, bubble crash. So prices really detached from earning because there was fear of the future. So even if companies are doing well, most of the companies, maybe some were not doing well, most of the companies were doing well, the markets showed a very different picture. Which means it is like, you're fine, everything is fine with you, your job is going on well, your relationship is fine, health is fine, but you still feel low. Mentally you're detached. So that is. Again, in 2009 to 2014, the markets were correlated. Again, during the COVID, markets were not correlating. There was a slight difference. And then again, it came up. Earnings catch up with prices. So if you see in large cap, this is the story. Let's take a look at mid cap. Mid cap also similar. Only during this time, it was low. Otherwise, 85, 68, 79, 72, 88. Almost similar to, right? 68, 79, 82, 76, 89. Almost similar to the large caps. Now let's take a look at mid caps. Similar story, right? So if you look at all the three, they have very similar stories. They are all moving together. And of course, there are some key drivers which talk about, right, why it is happening. And so this is the correlation. So let's take a look at overall large, mid, and small cap. This is the EPS, that is the actual profits, earnings. And here is the compounded returns. So if you see, slightly up here, actually almost the same, right? Here also almost same. The correlation here is higher compared to these two. So friends, This is a very important slide. You must understand this, that as long as the corporate earnings are good, markets will go up, and the GDP. Corporate earnings are good, which reflects the GDP and market values. Let's take a look at it, how it looks graphically, right? So here we've started on the same, right? Both metrics indexed to 2001 baseline. So here, if you see Nifty 50 index, how it is, there is a slight gap, but they both are going up together. You see, earnings are what is important. As a lot of fund managers say, markets are slaves of earnings. As long as the earnings are there, the markets will go up. And here, a consolidated look at the GDP, the average EPS, index, mid cap, and small cap. So here is the Nifty. So here is the Nifty, and this is the Nifty 50 index. Here is the Nifty 50 EPS, which is the corporate earnings, and here is the small cap. Here is the mid cap, and here is the GDP, the blue line. This is the GDP. So if you look at all of them, they are all going up in the same direction. There is definitely some gap here. For example, GDP has grown so much. Obviously, GDP is an average of all the goods and services in the country put together. So obviously there will be a gap. And here also the EPS has grown from here to here. This is an average, all companies put together. But what is most important is what has happened to the markets, the Nifty 50, mid cap, and the small cap. That is what shows, this is what reflects what has happened in the corporate world. So we have seen the GDP, then we have seen the markets, large, mid, and small cap. Then we have seen corporate earnings and how they correlate, how corporate earnings correlate with the markets. So this is a very important slide that we just saw. And now what we will do is we look at mutual funds. How have mutual funds behaved and what are the returns? So now we come to a very important section of this video is the mutual funds, the 25-year performance analysis from 2001 to 2025. So what is this summary? Over the last 25 years, Indian mutual funds have delivered exceptional wealth creation with mid-cap funds leading at 18 to 23% CAGR. 18% means 1 lakh has become around 60 lakhs. 23% means 1 lakh has become 1.75 crores. Just 1 lakh. No property or no other investment, not gold, not silver, has given so much. And 26% CAGR means 1 lakh has become 3.23 crores. That is the number. That is what mutual funds have delivered. Now we'll look at the large cap mutual funds, the top performers, right? So here are the top performers. So in the last 25 years, what have they given? Franklin India Blue Chip has given 16%. A 10,000 SIP for 25 years would have given you 1.08 crore, which means 10,000 per month is 1,20,000 in a year. It is an investment of 30 lakhs, which means 10K SIP for 25 years is 30 lakhs. And 30 lakhs has become 1.08 crore in a large cap. And then HDFC Top 100, UTI Master Share, all have given some exceptional, very good returns. So HDFC Top 100 has given 1.47 in an SIP. Basically, 16% means 1 lakh has become, 1 lakh lump sum has become around 40 lakhs. 18% means around 62 lakhs and 13% means around 21 lakhs. That means 1 lakh has turned into so much. Let's take a look at mid cap. So mid caps have given 20%, right? And the same 10 lakh, which 10K SIP, which means 30 lakhs has made it into 8.81 crore in Nippon India Growth Fund and Franklin India Primer Fund, 6.52 crores. That means a person like me who actually lived through all this, if I had started my SIP, just 10,000 rupees, and I could afford 10,000 rupees with my salary, probably 5,000 rupees. If I had done very sincerely an SIP in one of these funds, I would have had around 4 to 8 crores very easily. No effort. I would have wasted that money. I was not disciplined. So this also tells us about the future. If you are sincere, you can see such returns. Of course, we'll come to that section about the future. But right now, this is what it tells about the past. So 22% means 1 lakh has become 1.4 crore. And 20% means 1 lakh has become roughly a crore. That is the kind of returns mutual funds have given, especially the mid cap. Now let's take a look at small caps. High risk, exceptional rewards. Now we do not have data of these. We did not have really small caps for last 25 years, but the highest that is seen is 15 years CAGR is there, but since inception, which means 2010, where it is 15 years, roughly 15 years, 16 years. So here you see one more year extra. Here is 2007. That's why the 10K SIP is not in the crore region, because you have lost those few years, this first 9-10 years here for these small caps. Nevertheless, extremely good returns. Basically, 1 lakh has turned into 20 lakhs in 15 years. Again, extremely good returns. Mid caps are wealth creation champions. In the last 25 years, and I believe even in the future, I've already talked about it in my other videos, that mid caps are the growth engine, because they're the companies which have moved from small caps. They're well established, growing companies. So this is the mid cap is the space where there's a lot of growth. Now the important question, and that's the reason I researched, how come mutual funds are able to give better returns compared to the market? The obvious answer is good fund management. But how is it that they're able to get this better returns than the index or the benchmark Nifty 50 or Nifty Mid Cap 150 or Nifty Small Cap 250? These are all the indexes. But how is it that these mutual funds are able to give better returns? And again, let me remind you, the corporate earnings are also around 18% for mid cap. So how is it that mutual funds are able to give better returns, better than the average corporate earnings? Of course, they pick better companies. And let's take a look at this slide. So here's the quantitative evidence of outperformance of mutual funds over indices. One of the best advantage that they have is stock selection, right? They don't have to select stocks only from the index. They can go outside of the index, outside the Nifty 50, they can select. These companies are able to pick, their portfolios have stocks that drive performance. Top 20 holdings drive 80% of outperformance. In fact, this is also true of the index. In the index, the top holdings actually generate more returns. And just imagine a fund manager can choose the good ones and not choose the other ones, not choose the poor stocks, poor performers. There's a category flexibility also. For example, mid caps have 65%. You must have 65% of mid cap stocks. The other 35% need not be mid cap. So there is a flexibility. They can go for large caps so that there is stability and there is not, the downside is protected. They can have a little bit of debt, or they can also have small caps, which can generate better returns. So that is the flexibility. And then governance inclusion. There are a lot of probably banks like PSU banks, Yes Bank, Vodafone. These are all part of the index. So the index has no choice. But as a fund manager, they can exclude these PSU banks, especially because they have a lot of NPAs, non-performing assets, loans which are not repaid. So they don't do well as companies, but they are a part of the index. But a fund manager can actually choose. Then cash management. In an index fund or in a benchmark, you cannot have cash. As much as possible, it has to be deployed. But in fund management, active management, the fund manager has a choice. For example, there are some fund houses which always have 5 to 10% in cash, up to 10%, 5% on an average. And they keep this cash so that when the market falls, they can purchase cheap stocks at cheaper prices. Right now, there are some companies which have had cash. Now they're taking advantage. They did that in 2025. They did that in 2020 also, even in 2008 crash. And that's the reason they're able to generate this alpha. And again, we must congratulate our fund managers in India who have done an exceptional job by taking actively part, active management, and that's why they're able to get better returns. And obviously, what are these stocks that they have selected which have outperformed the indexes with a large margin? Let's take a look. HDFC Bank in 25 years has given 18,500 returns. Most funds hold this stock. And earnings CAGR 28%. It has given 28%. That means 1 lakh invested in HDFC Bank has given roughly 4.8 crores in 25 years. The profit share was 0.2 of the GDP. Now it is 4% of the GDP. See the jump. Same with Reliance Industries. See the returns. See the returns. So these are the CAGR returns. So if you had a lakh in any of these, it would be in crores right now. 1 crore, 2 crore, 3 crore, 4 crore, 5 crore. This is the kind of returns these stocks have given. And if mutual funds have invested in these stocks, obviously they will give better returns than the index. And they will give better returns than the average corporate earnings because they have picked the right stocks. That's the reason I believe in investing in mutual funds than investing directly because mutual fund managers know what they're doing. They're researching companies. They're able to pick the right companies. They're able to pick the multi-baggers, which many of us would miss. So now what we will do is in this section, this we have completed GDP, the markets, corporate earnings, and mutual funds. And now we will look at the analysis, integrate all these things, and see a big picture of how our country has done in the last 25 years. And this will be interesting. And then we will close with the future outlook. So here is the integrated analysis, a very interesting graph. Yes. So let's pay attention to this. We'll spend a few minutes here and look at each of these components, how they look as a large picture. So 2001, this was the GDP, 485. GDP grew by 4.82. Nifty EPS, 50 EPS was 65. Nifty index was 1105. And in 2005, what happened? See the growth up. This is the average EPS. This is the average. This is the GDP, average EPS. The GDP growth 9.2. Average EPS has gone up. Corporate earnings were 16.5. Nifty 50 index was 2836. Large cap growth is, right? So here is a growth from here to here, 20.8%. Nifty mid cap had just probably started, 1000. Average large cap mutual fund CAGR was 13.5 and average mid cap CAGR was 18.2. So this is what is the growth. And now from here onwards, we see 2010, what happened? Doubled. Here also almost the same, 8.5. The growth is 8.5%. The Nifty 50 EPS has gone up. Corporate earnings 12.9. They have come down. Nifty has gone up. And large cap index returns are 16 point. Large cap price growth is 16.8. Nifty mid cap 2200 and it has gone up. Growth 17%. And here average large cap mutual fund returns is 14.2. Corporate earnings is 12.9. Large cap price grew by 16.8, but average large cap is slightly down. The top funds would have given more. And here the mid cap price growth 17%, but average mid cap has given more. And if you look at it from 485, it is the GDP is now 4.2. It is grew by 6.2%. Nifty, his BPS is 1070. The corporate earnings is 11.9%. Nifty 50, this is the average 11.9%. Nifty 50 is now 22,000. Price growth 10.8%. Mid cap 22,000. Growth is 18%. Small cap growth is 15.4. Again, mid cap is the winner. And the average returns 16.5, 19.5, and 20.5 of all the mutual funds put together. That is the average. And in the last this is the 25-year, India's GDP has grown by 11.2 in billion dollars. And here is that means this is the nominal. This is the real GDP growth if you take out inflation. And here 11.3 corporate earnings and the average EPS is almost the same. Nifty 50 is given 13.75. Large cap, of course, 13.75. Mid cap 18.2. And small cap, Nifty, small cap 250. And here are the returns. Mutual funds again have given more. Now, this is a full integrated analysis of all components put together. One theme comes out of all this is our country has grown, markets have grown, corporate earnings have grown, mutual funds have grown. And how much has the mutual fund industry grown? in the last 25 years? Let's take a look. In March 2001, it was 90,000 crore, which is 20.7 billion. Of course, those days, the the rupee was around 45 rupees per dollar, and now it is around 85, 90 rupees. So the difference is 90,000, 587, and now it is around 82 lakh crores, which is almost $1 trillion. And here it says monthly peak 64 lakhs new investors added in 2025. And if you look at the growth drivers and milestones, it has grown by 35% per annum compounded, a staggering 830 times growth since 2001 to 2025. Investor base from 2 million portfolios, roughly 2 million folios, now it is 18 crore unique investors. That means from 20 lakhs to 18 crore. 64 lakh were added in 2025 alone. As a percentage, it was 2.5% of the GDP. Now it is around 20% of the GDP. In USA, if you were to compare, it is 150%. Global average is 50%. So we are not close to neither the global nor US, of course, but we are catching up. SIPs in 2001 was negligible. Now it is around 30,000 crore per month. Annually, there is 3.5 lakh crore of SIPs, and there are 8.5 crore SIP accounts. So this is the growth of the mutual fund industry. So if you see, the mutual fund investing is directly impacted by the markets. Markets are impacted by the earnings. And mutual fund industry has carved an industry of its own, which is now growing. And if you are a part of that, congratulations. If you've never invested in mutual funds, or if you're skeptical about mutual funds, probably this slide should help you. And now we come to the last part, which is the future outlook, the future projections. Now, just a disclaimer before I do this, this is not my predictions. This is based on all the information that are there. There are a number of sources which have made this possible. So this is not what I think, and need not be true. This is based on all the experts who have commented and all the quantitative way of looking at it, predictions, analytics. Okay. So this is just a projection. This need not come true, but nevertheless, these are good projections. So let's take a look at it. So GDP, 4.2 trillion is expected to become 8.5 trillion by 2035. That is expected CAGR of 7.3%. Now, which is based on what? Because of course, corporate earnings and all the other consumption, etc. So corporate, the EPS is 1070 right now. Expected is to more than double. Expected CAGR is 11.6. Large cap, the CAGR is right now, the Nifty is 22,000, and mid cap and small cap, the expectation is in the next 10 years 65, 85, 72. Very important number. And this is the expectations. 11.4%, 14.5, 14.9%. So the assumptions is that GDP will grow by 6.5 to 7.5 real plus the inflation, and corporate earnings is basically 1.5% of GDP. A rough estimation that this is usually the corporate earnings are more than the GDP, and then market returns, earnings growth plus dividend yield. So based on this is the assumption. So if you are investing, if you are thinking of the next 10 years, 15, 20, 25 years, this is what you can take a look at, especially for the next 10 years. Finally, the conclusion, the India growth story. Over 25 years, India has transformed from $485 billion to $4.2 trillion. Corporate earnings growing 16.55 times, and equity markets delivering 13 to 18% CAGR across categories. Earnings drive long-term returns. Correlation is 0.62 to 0.73. I mean, earnings is the key, the most important things. As long as our corporate earnings are good, eventually in the next 5, 10, 15, 20 years, they will match. So keep an eye on corporate earnings. Don't keep looking at the markets. Markets may go up and down. If this is going down, increase your SIPs, increase your investments. When it goes up, just wait. And probably if the markets are going up, if you think your financial goals have been achieved, or you will have in the next 1 or 2 years, withdraw. Mid caps offer best risk adjusted returns. Active management adds alpha, and SIP is the wealth creation tool. So this is what is the takeaway. And the final slide Do this again, this slide. So for the next decade, investors should focus on large cap funds as a core portfolio for stability and regular growth, mid caps for core growth allocation. So these are very important. These are very important part of your portfolio. This could be a satellite alpha generation. So I have a small portion in small caps. You can watch my other videos where I've exactly mentioned how you can have what is the percentage. Flexi cap also should be a good part of your portfolio. In fact, flexi cap includes these two, especially the large caps, and continue your SIPs. So, friends, this was the 25-year journey and what the future looks like. There is a lot of noise, markets falling, tariffs, and in FIIs pulling out, rupee falling, a lot of things happening. And we'll soon have the budget, probably that can make some difference. We recently had the EU deal, the mother of all deals is what is mentioned. So good things are coming up, the economy. Trust the government, trust the businessmen, the industrialists of our country, trust the markets, the mutual fund managers, and you be faithful in what you're doing. Stay invested regularly, trust and be faithful. Continue to invest so that your money will grow in the long term. There is no doubt. There is no doubt money will grow. Unless there's a world war or there is a catastrophe. But in that case, you won't even live. So, on this positive note, let me end. If you liked this video, if you learned from this video, if it has changed the way you think about investing, please like. And if you have not subscribed, do subscribe. And if you think this video will be useful for somebody else, please forward this. Forward this so that many more can watch this, learn from this, and be confident. And if you are a young couple, this is the great opportunity for you to invest. If you're in your 40s and 50s, don't give up. Continue investing. And I'll see you soon.